Hey, everybody. Thank you, Vic. See you out there. I hope everybody can hear me okay. I'm just going to jump in and go straight on with the story. So, the story today is recession risk rises. That was the making sure the recording works. It always strikes me how the markets are so fickle. You know, all of a sudden, the mainstream media starts talking about recession and everybody freaks out. Markets fall, etc. So it's going to be a little bit of the story today. We've been talking about this for probably 6 months now. It's pretty clear. Q2, Q3, or Q1, Q2, I can't remember exactly. We're recessionary. Yield curve is highly inverted. But the rest of the market doesn't kind of know it yet. So the big question is, are we going to get a Christmas rally in the stock market, and what's going to happen with crypto? I think we are still in with a good chance. But US stocks did extend some declines today. And again, fears about the Fed and interest rates. There's going to be some Fed stuff happening this week, some prints as well. So we'll watch for that. But there's also some optimism surrounding China's reopening and other stuff. So let's just go, as usual, edutainment. And now let's look at perspective for a second. This is the crypto market divided by Bitcoin. Basically, all other assets compared against Bitcoin over the last 7 days since I last showed this. And as you can see, Jabba, BNB is down. Stablecoins, XRP, Doge, Cardano down. But the rest of the market's green. Let's flip to what it looks like in US dollar terms. We get a lot of dark green. ETH far outperformed Bitcoin. So did DOT, so did Solana, so did Avalanche, etc. Litecoin, you name it. Market is kind of good. Let's look at equities since the last week now. I'm well aware equities are very red today. It was a bad day. But looking at the last 5 trading days, it's not too bad. It's still kind of up. Google's still up 3.5% despite losing quite a bit today. Amazon is kind of flat. Tesla sort of flat too, etc. So they're just, there are down days and up days. And there's no doubt that the types of market conditions we have and have had in crypto and in the summer are choppy. They will continue to be choppy as we go forward. So it's a lot about trading in and out, in and out, in and out all the time. Buying and holding really is hard unless you want to build a solid position in a really good asset for the long term. Because as many people will say, yes, things are beaten down. Is it the bottom? No. Is it extremely close to the bottom? Yes. Is there upside? Yes. If you have time, 6 months, 12 months, a lot of upside to come. So let's talk about the good news first. Believe it or not, despite all the negative sentiment, there's a lot of good news out there. So first of all, I won't bore you to death with too much on-chain today, but this is the MVRV Z Score, once again from On-Chain College, and he put this beautiful little chart together to highlight what happens after a period where the MVRV Z Score is down. Now, the question you have to ask yourselves, are we in 2012 or 2015, or are we in 2019, 2020, and 2022? So the question is this time different? And how long will we be down here? And many people think this is, extremely close to the bottom. Most of the shoes, or at least the significant black swan shoes, have dropped in this market, and everything should be positive from here, but we'll see. Again, we could roll into 2023 with continued choppiness, but also things could change radically. We're not sure. At least on-chain and technical indicators point to a lot of positive upside from here. Now, let's talk about the Dixie. And this is a big part of the story today as well. You'll see here that the dollar has erased more than half of this year's gains amid growing expectations that the Federal Reserve will temper its aggressive rate hikes and as optimism grows over China's reopening plans. Again, zero COVID going away. Now, the Bloomberg Dollar Spot Index, which you're looking at here, pared its 2022 advance to about 7% after gaining as much as 16% earlier, as slower than expected gains in consumer prices and comments by Fed Chair Jerome Powell stoked speculation the U.S. Central Bank will slow its pace of rate hikes this week. Now, that rate hike of 50 basis points is pretty much 81% factored in, which means it's a lock. Pretty much what it is above 75%, it's a lock at this stage. And that is a swivel from what we've had before. It'll still cause a lot of damage 6 months from now, but we'll talk about some of the damage you're already seeing in what I call Financial Armageddon news. But let's jump a little bit forward as to why the Dixie is so important. Now, I always talk about how Bitcoin has an uncanny ability to sniff out change, but this is brilliant. This is from, again, Bloomberg, and you can see here the orange is Bitcoin and white is the dollar index. Now, on the right-hand scale, R1, you will see the Dixie, but it's an inverse chart. It's backwards. And that shows a better correlation with Bitcoin, which is a log chart on the left. Now, you can see that both of them kind of travel in unison, with some exception at the beginning of June 2022, but more or less highly correlated. But what has happened that's very, very significant is that huge white spike. The Dixie has tanked. The Dixie has broken. We've talked about it a few times over the last couple of weeks. And Bitcoin has kind of remained flat. But if history repeats, as it normally does, we should bounce very, very soon. Now, what this picture tells a number of different things, but really the dollar index shows that the dollar has topped out, and you're seeing as well the Fed hikes will ease that we spoke about as well, plus other central banks are beginning to turn as they go forward. So that is a positive chart right there. Again, Bitcoin is still asleep because it's afraid of what other shoes could drop. It's afraid of the continued fallout from FTX, etc. It's afraid what may happen to Digital Capital Group with GBTC. That's why it's holding on. But once all that stuff clears, it should go back into correlated zones. So let's look at money flows for a second. This is digital asset investment products. And they did see minor outflows totaling minus 0.75 million. There's a tiny little click there on the far right in week 49, but ignore that because sentiment towards Bitcoin actually improved last week with inflows totaling 11 million. And why this is negative is the short Bitcoin products totaling 11 million drained out. And that's what you're seeing. So it is negative flow, but the flow came out of the short fund, which is actually a good thing. It means people aren't as bearish as they were before. Of course, why short Bitcoin when it's so close to the bottom? It's a dangerous thing to do. Now let's look at flows by assets. Here you can see that Bitcoin plus 10.8 and the short Bitcoin minus 11.1. Ethereum minus 4 million, which is pretty serious. And obviously there is still some negative sentiment towards Ethereum. Ethereum suffers from that, fear that maybe it's a security. And it's the third consecutive week of outflows totaling about, 4 million last week. And month to date is kind of flat. So call it 4 million for the month so far. Now, there is some concern with Ethereum about unstaking. So we're not sure exactly when or how much, but people are concerned about that too. Now, in some other negative news, Litecoin and Polkadot saw outflows of about 1 million and 400,000 respectively. And Solana and Polygon saw inflows of 200,000 and 300,000 respectively. Coincidentally, Solana and Polygon are our second and third favorite layer 1, layer 2 type solutions out there in the marketplace. Now let's go back to money supply and the uncanny ability of Bitcoin to sniff stuff out. This is special. And this is from Jamie Coutts at Bloomberg. And his thesis on this chart is basically global liquidity measures, which means quantitative easing, are starting to turn around, i.e. the global money supply is increasing. So if you look at the R1 side, the white, that is global money supply, and you see the way it's peaked up. And also, gold again is Bitcoin as a 10-month moving average. But basically, increasing global money supply is a tailwind for Bitcoin and the tentative beginning of a new cycle. And this chart is the global M2 money supply in dollars, rate of change. That's what ROC is for. Versus against the Bitcoin trend. And based on previous cycles, Bitcoin tends to lead a reversal in global M2 by 2 to 7 months. It's approximate, but it's sniffing out that increase in money supply again. Again, I always say QE to infinity because there's simply way too much debt, and you can't stop printing, especially when the rates are increasing as they are right now. So that is a positive one from Jamie Coates at Bloomberg. Now let's talk about Bitcoin hash rate, as we do feel for the miners out there, and it's been tough. But from Wolfie Zhao, he believes Bitcoin hash rate could fall the most, to the biggest decline since the China crackdown in July 2021. So I'm not sure exactly what that is. I pulled up the recent Glassnode hash rate, and they only have the data as of yesterday, and the date is December 5th. Today is December 6th, so we haven't seen that major drop-off yet, but it'll be interesting to watch. But so far, it is up there. And why do we care? Well, right now, with this high level of hash, it's extremely difficult for the miners to make a profit. Therefore, they are turning their machines off, and the system is self-regulating and dropping the difficulty for the miners, which is good for the miners. Now, in other strange news, we're going to bounce around, and we'll get to some more miner news in a second in the bad section, not in the good section. But here, Apple Car, it's called Project Titan. Now, apparently, they have delayed their debut until 2026. And Apple, it's no secret, but they have been planning their fully autonomous vehicle to launch. It was supposed to be, I think, 2024. They've delayed it by 2 years, and the car will cost just under $100,000. But they say the technology is not ready right now. Now, in the meantime, if you look how much they've been spending per year on this project, it's a very secretive project. It's been run by ex-engineers from Tesla. In fact, Elon Musk said there have been people who've been fired from Tesla, picked up by Apple, but they're very much sworn to secrecy. But you can see they've been investing heavily in this project, and nearly $30 billion probably going into it next year. But the problem is Tesla has such a head start on where they are and the miles that they are accumulating from FSD right now with so many hundreds of thousands of beta users. So Apple, in the year 2026, will have a very steep hill to climb, but it's good to see they're jumping in, and that could completely disrupt the car industry. Now, let's talk about what I, earlier in the year, and we'll see if it's right or wrong, I used to call Tesla a recession-proof stock, because things like Elon said, we can sell cars as fast as we produce them, as long as we can see into the future. His words, not mine. But this is kind of the stuff that I look at, is basic numbers. And if you look at this, I call this a free cash flow, that's FCF machine. And there is no other company, and drop a comment below if you can find one, that has at least over 40% compound annual growth of revenue, 25% ROIC, and that is return on invested capital, which is a calculation used to determine typically how well a company allocates its capital to profitable projects or investments. And there is no better capital allocator right now that I can find on earth. They have 15% at least free cash flow, and the stock is now trading for an absurd 30 to 33 price to earnings ratio on next year's earnings. So the question is, if they do, oh, by the way, per the chart here, free cash flow is the blue and net cash is their cash position. If they continue at this trajectory, there's no doubt in my mind they'll have over $20 billion sitting in the kitty, and they will do a stock buyback, and that will be a huge catalyst for the stocks as we go forward. So just hang tight, everybody. Tesla was super weak today, as with many other names, but this is a machine. So if anybody can find a stock that's growing more than 40% CAGR, 25% return on invested capital, 15% free cash flow, $20 billion in the bank, a moat from hell for the next 7 years, trading at a PE of 30, let me know. I'd gladly like to have that information. So next, speaking of Tesla and big Bitcoin bag holders, MicroStrategy is still the biggest holder. Marathon as a miner is number 2 with over 10,000 Bitcoin. And then you see Tesla at number 3, 9,700 Bitcoin, Square 8,000, Hut 8, 7,400, Riot Mining 6,500, and Coinbase 4,500, and on the way down the line. So interesting to watch this, that many of these companies are still holding. And as Bitcoin will arise from the flames over the next couple of months, these companies will stand to gain, especially MicroStrategy. They need to eclipse that $30,000 mark. That's when they turn profitable on their Bitcoin investment. That'll be a game changer. So next, let's talk about a little bit of real estate news. This is the underwater mortgages. You can see they are not spoking. They should be spiking. Sorry about my typo. But of the 450,000 mortgaged homes underwater at the end of Q3, nearly 60% are all from loans that originated in 2022, with purchase loans representing about 95%. And more than 250,000 borrowers who bought in 2022 owe more than their home is now worth. That's what underwater means. While another million or so have less than 10% equity. So this is what happens when rates go up. The cost of finance goes down. That drops real estate prices. And those that bought in 2022 are high probability, because real estate prices have fallen at least 10%. They are underwater right now, especially if they have very high mortgage rates. So that is a problem for many. Now, another little piece of macro charting news here. This is a Fed analysis. And per this from Jury and Trimmer, big thank you to Sanjay for sharing with me. The market expects the Fed to stay in the restrictive zone for a mere couple of months, 6 months or so, before dropping rates by 2%. That's 200 basis points after mid-2023. The question is this too good to be true? Are they going to be forced to do this because of what I refer to as Financial Armageddon? Well, people at Fidelity believe maybe it's possible. So we'll see. They talk a big game. They jawbone a lot, talk about being restrictive for a very long period of time, maybe the whole of 2023. They can't. And we'll show you some ugly news as to why we believe that's not possible. In addition, the ISM, that had a bit of a surprising bounce. This is the Institute for Supply Management. And the ISM is the number one indicator of manufacturing performances. But it did jump unexpectedly in November to about 56.5%. Up from a 2-year low of 54.4% that we hit last month in October. But it was the first advance in 2 months, and it did top economists' predictions of about 53%. But the thing is, this is where sometimes you need to have a seasonality dampener in there, because it's clear that the bump last month was from holiday sales in the US, as Black Friday, Cyber Monday, all that type of stuff. And that's when a lot of people do their shopping. And that's probably the cause of that as we go forward. In addition, oil news, which ties to inflation, and the recession, which we're talking about today, it tanked. Oil is now cheaper than it was at the beginning of 2022. Believe it or not, this is crazy, crazy downturn. In fact, it fell more since this chart was published a few hours ago from NYMEX. So I think oil is trading about $76 a barrel, which is kind of crazy. And again, as oil goes down, so does inflation. And that's why many experts believe we are already in a deflationary environment, but the data has not caught up to show that yet. And another final piece of good news, I think, before we get into the bad news, this is the IRA and CHIPS Act. They are working. So Tim Cook from Apple, speaking about Apple twice today, TSMC from Taiwan, and others unveil a $40 billion US chip plant to open in Phoenix, Arizona, which would be huge for the country. It'll also reduce the reliance on Taiwan for semiconductors. And it's good that the Taiwan semiconductor plant is involved in this as well. In addition, I think Bechtel are going to build Intel's new $20 billion plant in Ohio, and a lot of other good stuff. But this helps the world hedge the reliance on Taiwan, just, of course, in the event that China invades Taiwan as we go forward. So it's good. This takes a long time to build these plants, but it's a step in the right direction. And these new acts, the Inflation Reduction Act, which is comical, and the CHIPS Act, are helping make this possible as well. Now, switching gears to the bad news, only one piece of bad news today, but this is home prices, ties into the previous chart we spoke about a few minutes ago. This is the Black Knight Home Price Index. Again, you can see we are seeing very, very strong declines. These are near multi-decade low affordability because of the 14, 15-year high in mortgage rates. And this is happening all over the world, not just in the United States. So use this as a kind of a barometer to say what's happening. But stalling inventory levels are holding home prices a little higher than demand levels would suggest they are, which is kind of interesting. And home prices fell about 0.5% in October. And typically, November, December, January are dead months for selling real estate. And real estate sales are down 35% already. It's probably going to get a lot more. And obviously, because of, again, increased interest rates, they've smashed this entire market. We'll talk more about that in the ugly section that we are in right now. So first, we'll go back to the miners. This is all of the miners year to date against Bitcoin. You see Bitcoin year to date is down 66%. Obviously, it came off the highs in November and fell a little bit in December. But if you look at the other names, the least worst off from all the miners we look at is CleanSpark, down 78% year to date. Marathon number 2, 81.8%. Riot, 81%. Hut, 85.7%. Hive, 84%. Bitfarms, 88%. Argo, 94%. And of course, Core Scientific hit the wall, unfortunately. Now, we'll see how the rest survive. And hopefully, these guys will benefit from that reduction in hash rate that should hit today. So as soon as we find out, we'll let you know. Now, this is a quick glimpse into what I call the financial Armageddon and how jacking rates so fast, so hard is smashing things. So another proof of that is this. This is the fastest housing slowdown in the history of the United States. The red line is the speed at which the prices have tanked from the months from the first Fed rate hike. And remember, they haven't even gone through the system yet. There's a lot more pain to happen. And that's why we expect the average house price to fall by 20% between the time of the first hike and 6 months from now or so. So watch that space carefully. For those looking to buy, hold that cash, wait for the right time. But literally Q1, Q2 next year could be a good opportunity. And then the Fed should reduce rates per Fidelity above, and then it'll go gangbusters again. Now, this is part of the financial Armageddon continued as well. You spoke many times, if you walk through any major city like San Francisco, prime real estate area, whether it's office buildings or retail space, they're all empty or boarded up. It is actually quite horrifying to see. But now we have contagion, not only in crypto where withdrawals are paused, but commercial property funds face withdrawals as well. Big and small investors are queuing up to pull their money out of these real estate funds. And this is the latest sign that the surge in interest rates is threatening to upend the commercial property sector. We knew it with working from home and C19 and everything else. That has changed commercial property forever. The only thing that is hot right now in commercial property is storage facilities, so people can store stuff to ship stuff. And as interest rates continue to climb, the economy is poised to crash hard. And this is another worrying signal with Blackstone Real Estate Group Fund hitting its redemption limit, and now Starwood as well, REIT limits withdrawals as well after a surge in requests. Everybody's trying to pull the money out of their real estate REITs. And we had many questions actually during the year about, should I invest in REITs if I can't afford a house? I said no, maybe with the exception of old people's homes or memory clinics, that type of stuff, because they're in high demand. But other ones, stay away for now. But again, it'll bottom and then things will get better. We just have to wait for that time as we go forward. But these redemptions are crushing these companies. And maybe they want to redeem their money to be able to do things like buy Tesla or Bitcoin at these crazy low prices. Who knows? Anyway, enough of that. Let's talk about the yield curve inversion. Again, another harbinger of recession. This is very, very deep. This is from Ecoinometrics. You can see how historically it is way lower than anything since the late 80s. And that's over 40 years. So again, this always dictates a recession as we go forward. Final chart of the day. Be safe out there. Protect vulnerable loved ones. But during the winter season, C19 typically spikes. And here we see a massive COVID spiking. Now, this is only for people. It's a 7-day average for people that have the nucleic acid amplification tests. And remember, very few people are getting those tests. So the fact that, and most people that actually get sick just stay at home anyway, they don't even bother getting tested. So if this is reflecting a big spike, you can imagine 5x more infections that are floating around. So again, be careful of going to steamy pubs during the winter and everything else if you're vulnerable. If you've had it before, odds are you're okay, but just careful out there. So that's it, everybody. Thank you so much for being here. Thank you to everybody in the audience. I'll see you all tomorrow. Bye.